The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawkbox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Brent crude trades at a wartime high. As Axios reports, military chiefs will brief Donald Trump on potential further military action against Iran after he rejected Tehran's offer to reopen the Strait of Hormuz. Central banks remain in focus today, with the ECB and Bank of England expected to stand pat. This after the Fed keeps rates steady in what was likely Jerome Powell's final meeting as chair, but with the highest level of dissent since 1992.
A group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too.
Equity markets under pressure, but the Nasdaq holds up as investors cheer big tech earnings. The only outlier, Meta, as it raises its capex forecast again and reports a first ever quarterly drop in active users. Meanwhile, European equity markets prepare for a day in the red, with the surge in oil prices sparing London the brunt of the selling.
Very good morning to you all. Good morning, Ben, as well. Look, it's never this simple, but I'm going to try and make it this simple just for sake of argument. There are many props and many ingredients going into the market, many parts of the engine going into the market to make it hum along nicely. And I'm going to break it down into three for you as well, two of which I think are wobbling, one of which is acting as a solid prop for the market at the moment. The one that's acting as a solid prop is without doubt earnings, and specifically US technology earnings. I know that Meta had a wobble, but by and large, we are not seeing concrete evidence yet that the tech AI data center spending we're seeing is detrimental to the technology companies in the large. By the way, these are very, very big companies which have other things going on as well. So it's not just about AI spend. But the fact of the matter is that is acting as a solid bulwark for the market. The other things that clearly are not looking so good is the cost of money and the war. And the cost of money, as we saw with those three dissenters who wanted a more balanced statement from the Fed rather than a dovish statement, shows that actually the cost of money isn't going anywhere anytime soon, at least not to the downside. And that is what I think a lot of American companies, American individuals, and indeed, dare I say it, the sovereign, the US Treasury market, perhaps hasn't fully registered yet, even with Mr. Walsh taking over, potentially, of course, subject to Senate approval in late May as well. And the other prop is the market, and is the oil market, and is what is going on in the Middle East. And let me be very blunt from you. There's no doubt about it. The United States has a degree of immunity, but it is not immune. We see it in gasoline prices. We see it in diesel prices. We see it in all the costs associated with higher oil prices around the globe. So yes, US, you have immunity to a certain degree, but you are not immune. Remember that. I think it's very important to say. So the latest news, as we read in the headlines, is that US President Donald Trump is reportedly set to receive a briefing today on new plans for potential military action in Iran. This, as Axios reports, citing sources familiar with the matter. Crude prices extending gains this morning following that report, but it's been higher. Just look on the right-hand side of that chart. You can see a little bit of a blip before where it is trading now, 123.62. So crude price extending gains this morning following that report. Brent earlier today hit a 4-year high, with the global oil benchmark on its longest streak of gains in almost 4 years. And as I and my head of TV news were chatting this morning, actually, the spread between Brent and WTI is expanding once again. Dan joins us with more. Dan, far be it for me to say anything militarily, because I'm just a student of it like the rest of us, and not like the CENTCOM Pentagon experts. But if you do have more military action, isn't that just more of the same, given the fact that the Iranians have proved very resistant up to this point?
That's exactly right, Steve. And I think it's important to say it's hard to know what's real and what's posturing here, but it's quite clear that oil markets are reacting to the headline. We saw Brent crossing above $125 a barrel earlier today after Axios reported that President Trump will receive a briefing on a new military strike option for Iran from the CENTCOM commander, Admiral Brad Cooper, today. Now, according to Axios, US Central Command has prepared a plan for short and powerful strikes on Iran, possibly on Iranian infrastructure, designed to break this negotiating deadlock and force Tehran back to the table. Now, as of right now, I want to stress, Trump has not ordered any action, but it does seem that that is now a live option. I mentioned it's hard to know how much of this is real and how much of this is posturing, but Axios also reporting that Cooper gave Trump a similar briefing back on February 26th. That was 2 days before the US and Israel launched the war against Iran. Axios saying that briefing contributed to Trump's decision to go to war. So we'll watch and wait to see exactly what happens here and what the president ultimately ends up deciding. Remember, he has said previously that he does not want to go back to kinetic action and go back to conflict, saying he would prefer to reach a deal with Iran. However, the president has also told Axios that he now intends on keeping the Hormuz blockade in place. President Trump saying Iran wants to settle, but he has rejected their proposal to reopen the strait first and defer nuclear talks. He wants nuclear commitments before anything else moves, saying, I don't want to lift the blockade because I don't want them to have a nuclear weapon. And of course, as you would expect, Tehran is pushing back on this. Iran's parliamentary speaker responding on X saying, quote, next stop 140. In this latest post, he was referring to the price of oil and also dismissed US claims that Iran's oil infrastructure is near collapse. So that's the state of play right now. Look, frankly, if military action resumes with infrastructure targets in scope, and I would contend that's a low to medium probability at the moment, the risk premium in oil certainly does not come down from here. So that's why we've seen Brent testing 125 this morning, WTI back to around 110. Yes, off the highs of the Asia session, but still firmly elevated here with the risk of military action now back on the table. Back to you.
Thank you very much indeed for that. And I know that UAE and others must be just thinking, what on earth is happening next with those revenues? OK, Ben, let's have a look at these futures.
Yeah, this is what's being called when European trading gets started for the Thursday session in just under 50 minutes from now. Looking at a negative open, obviously the jump we've seen in the oil price weighing on equity futures there, fueling the concerns about inflation. Of course, investors in Europe we'll be watching for, I suppose I was going to say the decisions from the Bank of England and the ECB. Not so much the decisions, pretty certain that they're going to hold rates, but what they'll be looking for is the commentary and the direction of future travel, especially after we saw those divisions within the Fed on the future path of how the different members of the FOMC feel about the path of interest rate cuts. So that's the picture across the European markets. US futures, well, this is what's being called for when Wall Street trading begins later. And despite the strong earnings that came after the bell from the tech companies, we are still looking at an anticipated negative start to the session. It is worth saying, though, that all of the key benchmarks, despite those falls that are being called today, are on pace for a fairly strong month, looking to close the month of April higher than where they began. Extraordinary, really, when you think about all the uncertainty that's still going on in the world and the sustained high price of oil that we've seen.
The US Federal Reserve, as Ben was pointing out, held rates steady in an unusually divided vote, which saw the highest level of dissent since 1992, which I find extraordinary. We had dissent in a lot of other monetary policy committees globally. Why not in the States? But it's just not the norm historically. The committee voted 8-2 split, with Governor, guess who, Stephen Miron, dissenting in favour of a 25 basis point cut. What is he looking at? As he has done since joining the central bank in September. Beth Hammack, Neil Kashkari and Laurie Logan agreed with the pause, but said they did not support the inclusion of an easing bias in the statement at this time. It was likely Jerome Powell's last press conference as Fed chair before his term expires next month. Mr. Powell said he will remain as governor whilst a probe into the renovation of the Fed's headquarters continues.
I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair.
Yeah, guess who didn't like that? Scott Bessent. Now, that's not normally said. Well, these aren't normal times. Titania Kandari is a deputy CEO of the Solutions and Multi-Asset Group, leader of the portfolio manager for the Passport Equity Strategies and head of macro and thematic research for emerging market strategy equity team at Morgan Stanley IM. Titania, you have the longest business cards in the world. Congratulations. Guinness want to get on the phone to you because it is this long, your title. Amazing. What does that title tell you then about what you should be doing at the moment?
Well,
I wear many hats.
Yes. Thank you for the introduction. I think from the Fed's starting point from the Fed, I mean, that's where you started here. I think three things. One, inflation is not behind us. I think we've had 5 years with Fed, inflation above target. So you can't really look through this. So the bar to really cut rates is really high. I think with Kevin Warsh's Fed, one has to also think about the balance sheet and what that means, because he's talked about QT and reducing the size of the balance sheet. Of course, reserve management will be there, but I think that's the other thing to keep in mind. So on the interest rate side, we don't really expect cuts for the rest of the year. What should we be doing in the markets? I think a lot of what's happening globally is reinforcing the trends that have been going on for many years, right? Whether it's the deglobalization, it's the untangling of supply chains, it's building critical resources, national security purposes, from AI to defense to now in energy security. I think geopolitics has become baseline now, not tail risk.
Really interesting answer. Let me just go through one thing before Ben comes in. And that is, maybe there's something sly and very... I love a good conspiracy like the rest person, although most of them are absolutely bonkers. But what is interesting is the normalisation of dissent in meetings now is interesting, because given the historical norms at the FOMC, where there hasn't historically been large levels of dissent on the decisions as well, isn't it interesting that ahead of Warsh coming in, there is a more of a norm happening now where dissent is becoming more commonplace as well. It's a shot across the bows for those doves out there who think Warsh is on board, he's going to be dovish as well, regardless of what you say about QT as well, and actually everyone's going to fall in behind him. They're not. Kashkari's not going to fall in, Logan's not going to fall in as well, and others as well. Hamak's not going to fall in, and dare I say it, Mr. Powell himself isn't going to fall in line. So I think it could be a lot more contentious going forward on policy rate decisions.
I agree. And I think the whole template that, where we have cushioning on the monetary policy side with the Fed balance sheet, with the fact that there has been more consensus, that increases the volatility on the policy side and on the expectations side. So I think it will have implications primarily for the volatility and the anchoring of the Fed expectations.
With that in mind, Titania, it feels like the moves that you're seeing in different assets reflect two very different camps of thinking. You've got one where you look at the yields on government debt, and actually it's clear there are inflation expectations and the prospect perhaps of higher rates at some point. But then you look at equities and it seems like it's totally detached from that. When do you think, if at all, do those two worlds converge? Do they collide?
Yeah, great question. I was at the IMF and I thought there was a big disconnect 10 days ago between policymakers and between the markets. I think there is a lot of complacency on the Iran deal. Deal or no deal, the implementation of the deal is going to be an issue. I think markets are used to 25 years of stimulus and therefore, buy the dip mentality. What I do believe that in a lot of the inventory levels which are being drawn down, especially in markets like Asia, which are energy importers, you're going to see signs of those inventories becoming concerning in middle of May. So I think the markets are pricing an ideal scenario, and the Iran situation, there can be a deal, but what does the nuclear technical details entail? What does sanctions relief mean? How does all of this get implemented is the big question. And 80 plus energy facilities have been destroyed. Iraq, Kuwait, Oman will take 3 to 4 months to restart, even if the deal is signed today. So I think that equity markets will feel that pressure as we get into the next month.
One of the consistent things you hear from anyone in this world is you've got to diversify. If you're uncertain about what's going to happen, you've got to diversify to insulate yourself. But we're in a situation where the market gains have really been driven by the tech sector. Even if you had an index tracker fund that follows the S&P 500, 25% of that, I think, is going to be exposed to the Mag 7 companies. Where do people position then? Where do you position to insulate? If you do think, I'm a bit unsure about, can the market sustain these highs that we're seeing?
We have been in like the broadening trade and positioned for that, both within the US and even outside the US, right? So, AI has been the key trade. We, sliced and diced it into the infrastructure layer, the model layer, the application layer, and the, adopters and the enablers of AI. I think the users of AI and industry that are using AI to enhance their efficiencies on the cost side, on building business moats, I think that's a more diversified, broadening trade, even globally with our view on the dollar. And what all of this means to the credibility in the dollar as the main anchor means diversifying into different markets. Even to play the tech story, the North Asian markets have been a great place to be. So we've been diversified in Japan, Europe, in pockets of emerging markets, pretty much across the world.
Okay, we've got so much there. Jitanya, thank you so much for your thoughts and analysis on all of that. Jitanya Kandari from, was it JP Morgan? No. Sorry, my mistake. Morgan Stanley, the other Morgan. Sorry, I'm so sorry. I couldn't get through the titles quick enough to get to the name. But from Morgan Stanley, I am. Jitanya, thank you very much. It's been a pleasure to have you with us.
You'd be better off just reading the whole thing.
I should have done. We've been talking about all the market ructions, but if you want more details on that as investors digest spiking oil prices, tech earnings, central bank decisions, just check out the CNBC Daily Open newsletter. It's online for you now. But keep watching the show as well, because coming up, a tale of mixed fortunes for tech stocks as 4 of the Mag 7 post results after the US close. We'll have all the details for you. Plus, it's a super Thursday for central bank action across Europe today, with decisions due from the Bank of England and the ECB. We will discuss. And CaixaBank posts a 7% rise in first quarter net profit. We'll speak to the CEO, Gonzalo Gortazar, next.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Huge action on Wall Street overnight. Big tech earnings. Meta, Alphabet, Amazon and Microsoft all reporting first quarter results, all beating analyst expectations, but diverging actually in after-hours trade. Just looking at the numbers, Alphabet easily won the big tech earnings night. A strong sales beat driven by Demand for its cloud computing units saw shares 7% higher in extended trade. The company also updating its capex guidance box. I don't know. There's just some weird letters in my prompt, actually. It's not box, it's BDX, whatever that means. Moving on. Meta had a harder time making the case to investors. I just read what's on there. I'm just like Anchorman. Shares slumped 7%, making it the biggest underperformer of the group after disappointing on user growth and capex spending plans for the year. Investors appeared to like Microsoft's latest set of results and spending plans. Its capex for 2026, the forecast coming in well ahead of analyst expectations. Oh, how quickly things change. More capex is good nowadays. The company are forecasting $190 billion for the year, up more than 60% on last year. And Amazon posted a beat on the top and bottom line and reported cloud sales ahead of forecasts, pushing the stock higher in extended trade. Revenue in its cloud segment increased 28% on the year to more than $37.5 billion, its fastest growth in more than 3 years. And Qualcomm shares stage a dramatic turnaround after the bell, as CEO Cristiano Amon said on the earnings call that it would begin shipping data center chips to a large hyperscaler. Wow. Within the calendar year, with more details to come. The stock initially fell as much as 7% after the chipmaker reported second quarter earnings that topped Wall Street estimates, but fell short on forward guidance. CNBC's John Fort will be interviewing Qualcomm CEO Cristiano Amon live on Money Movers later today. That's coming up at 4:30 p.m. London time.
First quarter net profit at CaixaBank rose 7% on the year, coming in ahead of expectations at 1.57 billion euros. I'm delighted to say Gonzalo Gortazar, the CEO of CaixaBank, joins us now live on the show. Very good to have you with us. Just run through the numbers and what you put that all down to.
Well, thank you, Ben. We published a very strong set of results this quarter on the back of a very resilient Spanish economy, which allow us to keep growing our business by 7% on average and actually have a very good asset quality with non-performing loans coming down. So return on tangible equity at around 18% and a new share buyback program. All good news, particularly in light of the current geopolitical circumstances.
And that is the most pertinent point to continue the conversation on, the uncertain geopolitical circumstances. You've had a strong quarter, but looking at the quarter ahead, how concerned are you by the headwinds that could create, and how do you plan to deal with it?
Obviously, the current situation is not good news for anyone. But when you look at it from the Spanish economy point of view, the resilience is very remarkable. No, even Bank of Spain in an adverse scenario is saying that GDP is going to be growing by around 2%. We, as the largest bank in the country with 25% market share, are obviously going to be very much following that development. So we are still feeling reasonably okay with our business and the expectation that we will continue growing both business volumes and profitability, even in the current circumstances.
Morning, Gonzalo. Isn't there a better... it's an old sore for me, but why are you spending $500 million on a share buyback program when your shares have rallied anyway from just under €7 to nearly €11 in the last year as well? I'm sorry, isn't there nothing better to do with that money?
I think buying back our shares is what makes sense when we have excess capital. The priority is to grow the business organically, and we're doing that and in a fast manner, 7% growth in loans this year. But once we do our organic business, in the absence of M&A opportunities, which we do not see, the most logical action is to return capital to shareholders. I had been told when the shares were at 8 that maybe that was not a good thing. Now with the shares at close to 11, it's still the same story. We feel there's good value in our shares, and if we don't have another use of capital, that's the right one.
Yeah, it was probably me that told you it was no good at 8, Gonzalo. I mean, knowing my past forms, almost certainly was me, Gonzalo. Look, why aren't there M&A opportunities? I mean, of course, we know that at least one of your big rivals is looking for some chunky deals. Is it still all about Spain, or are we seeing any sign that it's worth having a look over the border?
There's no real value creation in cross-border transactions in Europe today. We need to have a real common market, both for goods and services, and particularly financial services. Well, that is not present, and it's unfortunately not here, not likely to be here in the short term. We just don't see that value, and I think our duty to shareholders is return that capital back to them rather than spend it in non-value creating ideas.
Fair enough. Well, we won't go into the semantics of why you're not increasing the dividend rather than the buyback in a meaningful way. But look, the non-performing loan balance has fallen by 278 million euros as well. Incredible trends, actually, given the fact that the cost of money may well have bottomed for the medium term as well. Are you cognizant, are you concerned that actually the ECB has got to start raising rates?
Well, I think it's the right course of action for the ECB rather than us being concerned or praising it. It's just logical. Inflation is going up. That's a fact. It's a certainty. Future for the 2-year inflation rate are now above 3%. In order to maintain credibility, I think it makes sense to raise rates at some point, not in a major way, but enough to make sure that long-term inflation expectations are contained. So that would happen, and it's not necessarily bad news for our business, given our NII, our net interest income sensitivity, which is positive in case of an increase in rates.
Gonzalo, I have to say, when I look at certain measures, cost to income ratio really shines for you. Anything below 40%, I think is quite staggering, and you're just a whisper below 40% as well. Are you not seeing any pressures on the cost front at the moment? Because it looks like a great cost to income ratio.
It is, and we're very happy. What we are seeing is obviously some inflation pressure on costs and some discretionary decisions we've taken on particularly IT spend, where we're doing over 5 billion in this 3-year period. But then fortunately, we're being able to generate more revenue growth than what we were expecting. So all in all, the cost income is going to trend down and even below the current rate. We're getting closer to the target we have for next year is high 30s, but the trend is pretty positive even beyond next year. As long as we maintain the high level of activities, the gains in market share that we're having in Spain and Portugal, which again we see as feasible.
Gonzalo, I just wonder, we've heard about various banks and their potential exposure to private credit and the potential write-downs, losses we're seeing in that space. What's the situation with CaixaBank? Is it affected at all?
No, we're not. We have no exposure, so zero exposure to private credit. That's not our concern. One additional reason for us to be positive on the outlook.